Welcome to Venture Step Podcast. We discuss entrepreneurship, industry trends, and the occasional book review. Everyone's felt the hardship of insurance if you live in a catastrophic-prone area. That could be anywhere on the East Coast and on the West Coast, particularly California. And if you're in those areas, you're acutely aware of the relationship or the growing relationship and imbalance of insurance in those areas. And I myself work in insurance and have a couple hypotheses that we'll discuss later on in the episode. But just throwing it out there that this is for my SUS Learnings continued content series. And SUS Learnings, there's quite a few of the episodes now. I think I'm on my third one, or this is my fourth one. But basically, the SUS stands for the Startup School, and it's a free startup mentorship program offered by Y Combinator. So it tells you, okay, this is how you create a good idea. This is how you find a co-founder, and this is how you raise money, and this is how you deal with equity and arguments and all sorts of things. And try to get you ready for all the challenges that are unknown, but are somewhat common no matter which business you're in or startup you're creating. You'll have these recurring issues, and they try to get you squared away for the recurring issues so you can be more prepared for the unpredictable issues in each person's respective industries that they're working in. So this is an SUS episode, and this episode is more related to insurance and the growing trends of insurance and some hypotheses. So my hypotheses are, let's see. Okay, so it starts at the bottom of the page. I'm going to read this out loud. Extreme weather events are increasing in severity and frequency. And basically, if you don't know what that means, is there's catastrophic events more often and they're costing us more money. So call it hurricanes or wildfires. Those would be the main ones that people are concerned about. Hypothesis 2, and I'm talking about the US market, by the way. There is a lack of appetite from the capital and reinsurance markets to insure these types of risks, so insurance carriers are able to take less risk in those areas and not offer coverage. And what I mean by not offer coverage is a carrier or an MGA, and you don't have to get too specific. It's just that people that offer the coverage or create the product or manage the product, they, for the most part, aren't comfortable taking risk as what's called net risk and taking everything 100%. So they share the risk with the reinsurance market and say you're not comfortable taking 100 because your 100 could be a 1 in 1,000 year storm or a 1 in 250 or 1 in 500. Whereas like the likelihood of these things occurring are low, but if it does occur, it would be a massive loss and you need to have the appropriate capital to take on that risk. So it's easier to spread that risk with other folks. That's basically what I'm saying. What I said in hypothesis 2 is that there is a lack of business appetite for people to offer capital to insure properly in those areas. And so there's a lack of supply. And then the third hypothesis is if you're offering coverage, then there's an issue with very high deductibles. Typically, you would see like a 5 to at least a 2% deductible for a catastrophic storm and other limitations regarding roof. And so your roof there's two perspectives, right? Like if you're an insurance person, there's so many people that treat roofs, especially in Florida, roofs or insurance policies for their roof as a maintenance policy, like where it's not about the usefulness of the life of the roof. It's like, okay, I had a little storm, I need a whole roof replaced. And so people have these old raggedy roofs that they were just getting replaced constantly because they also never had to buy their own roof. It was the insurance companies. But since you got a free roof, other people have to pay for your roof that you got, and their insurance gets more expensive. So does yours, and so does everyone else's. And if people keep doing that over and over again, then insurance, there's a lot of various other things, but that was like a big thing in Florida where contractors were pushing people, like giving gift cards to people to help them put in a roof claim, like walking houses after storms, not even big storms, like a rainstorm or something, going up on their roof and seeing if they had any pre-existing damage, then making a claim after that storm, giving people gift cards, all sorts of weird stuff that is now illegal. But there's many issues, but that was one of them. Just providing a little background. Hypothesis 4, the only time that you will really be paying and making a claim and then an insurance company paying is if it's over your deductible. But in these scenarios, it's almost kind of like a total loss. Like if you have a 5% deductible on 500 grand, then your deductible is 25 grand. If you have a $25,000 claim and it's not related to your roof, then like you've got big problems. Like you have a lot of things going on. So there's that, and 25,000 is a lot to pay out. That's a lot of money. I don't know very many people that have 25 grand on hand ready to pay out when they have an insurance claim for a weather-like event. Like I don't know anyone who has some kind of money set aside for insurance that they have in the S&P and they just leave it there for a rainy day. I mean, people have emergency funds, but the emergency funds are built for a lot of other things, not necessarily for like a $25,000 payment for your deductible to even get coverage. So that's kind of the issue. Hypothesis 5, there's a lot of supply and demand, but there's a lack of capital. So there's always factors that are pushing things from being a less competitive and less customer-friendly market to basically dictating the terms. So what I mean by that is that there was a period where reinsurance kind of pulled back from these areas because of all the risk and how the market has been changing and all those things. And we'll talk about that. I'll share my screen and look at some graphs with you. But the main thing is that there's not a lack of capital. There's just a lack of interest of applying that capital in those areas. And so the people that are offering coverage in these catastrophically prone areas basically dictate the terms of the market. And that's good and bad. Like for an insurance company, that's great. For an insured, that's bad. So you don't want that. You want to have options and you want to be able to have various coverages and prices and different perspectives on your risk, because each company will have specializations in different areas and will be more comfortable and price you in a certain way that you may like, but other insurance companies may not. Hypothesis 6 is insurance is increasingly becoming more complicated, and with all these factors being pushed onto the customer, puts people that are getting these insurance policies into thinking it's a scam. They don't think highly of it. So those are my 6 hypotheses. So now the next thing that we'll be talking about is kind of just going through what's going on in the market. And I'm thinking about all these things because I had conversations with a couple co-founders over the last couple weeks, or leaders in the parametrics market. And they had varying perspectives, but then their varying perspectives gave me a different insight on potential directions of which I could build a company from. And the first item is that insurance is becoming very expensive, and also the deductibles are very high. So insurance is going up, insurance is going up, deductibles are going up. So overall, you're getting less coverage for the money, and your money has to pay for more of the coverage. So there's that. And then the core problem of all of this, and the reason why we're going through this whole rebalancing, is whatever you want to call it. I'll call it climate change. If you want to call it some other thing with just random occurrences of storms, whatever you want to do. But with this climate change model, with storms, with their frequency and severity increasing, it is a problem. Like, we've got to figure it out because things are getting out of control, very expensive. And I have some suggestions on like things to do and not to do at the end of the episode. But that was another thing that I'm going to be discussing in this episode. And yeah, and then I'll also discuss my perspective and my conversations with the co-founders. So the first thing we'll discuss the increase of frequency and severity in the world for catastrophic events. I'm going to be discussing the US market because I live in the US and I'm most familiar with the US, but the same premise applies to the other markets like the European market, Africa, everywhere. Okay, so let's go over here and I'll share my screen. Screen. Yeah, I always wonder what people think when I am trying to share my screen. I'm struggling and they're not watching the video. Like, what are you talking about? Okay, so this is from the National Centers of Environmental Information. And they have a graph. And basically, it's a graph from 1980 to 2025 as of April 8th, 2025. There has been 403 confirmed weather and climate disaster events with losses exceeding 1 billion each to affect the United States. These events included 32 drought events, 45 flood events, 9 freeze events, and 203 severe storm events, 67 tropical cyclone events, 23 wildfire events, and lastly, 24 winter storm events. From 1980 to 2024, the annual average is 9 events. The annual average for the most recent 5 years is 2024 is 23 events. And you can look at this graph, and if you're not looking, I'll describe it. It's a graph of the total disaster cost, amount of events, what type of event it was. And it's very colorful. There's a lot going on. It's very informationally dense, I would say. But if you look at the last couple years, like just 2023 and 2024 were massive years. Like, it's just off the charts. Like, it's literally at the top of the box. And you can see that from 1980 all the way over to 2025, there's a slow hockey stick like slope to the graph where in 1980, and this might be an issue with the data collection, I'm not sure, but in 1980, they had 1 tropical cyclone event, 1 flood event, and 1 drought event. So they had 3 events that year. And it seemed that like every 3 to 4 years, there was an event spike. So then the next event spike was in 1983. There was 1 cyclone, 1 freeze, 3 flood events, and 1 drought event. And then if you scroll again, there was a spike in 1985. That was only a year later, like 1 full fiscal year. And then in 3 years after that, there's a spike that's lower than the previous. But it typically has like some ups and some downs, and it's not very consistent. But if I look at 2023 and 2024 and what is predicted to be 2025, they seem to be very consistent. Whereas like 2023 had, let me add these up mentally. 28 events. And I don't know why that took me so long, but I was like, oh man, people are viewing my screen and they're seeing me count. And I'm like, ah. So that's 28. And then 27, 28 and 27. And I could have also looked to the left and look at the number of events. So that's my bad. I'm just sharing live. So it's very clear that the number of events are increasing. And if you look at the other chart the other axis to the right on the Y, within that Y axis, the cost is increasing substantially too. In 2022, we had quite a few events. The total cost was just under, let's see if it tells me the exact cost. They're saying within a 95% confidence, they were saying in 2022, it was 135 billion to 232 billion. If you fast forward to a couple of years from now, it's saying, oh, wait. Sorry, I messed up. My bad. Erase what I said. The cost in billions is just under 348 billion. And you fast forward a couple of years, 2023 was a record, the type of record that you don't want. And that was 521 billion. And then 2024 was just under. And we're predicted to have another strong 2025. And so the costs are consistently increasing and the frequency is consistently increasing. That's been validated. The next thing that has to be validated in this series of statements is the amount of capital. So the next thing is, okay, well, what if there's not enough capital because the reinsurance group is being hurt by these events and costs are increasing and there's not enough capital to put at play to offer enough coverage. There's not enough supply of capital or interest. That is just fundamentally not true. So in year 2021, I'm reading off my notes. In year 2021, the dedicated total reinsurance capital, this includes traditional capital and alternative capital. And I'll explain what that difference is in 1 second. But total was 530 billion to 575. And then go to 2023 or 2022, there was a dip and it went from 490 to 530. 2023 came back strong, 470 to 700. And 2024, 115 to 770 billion. And in 2025, we are apparently recording a record in reinsurance capital. And so I can share that. This information that I'm getting is from Gallagher Re. Gallagher Re puts out a reinsurance report, a yearly reinsurance report. And this is what they're predicting. I mean, 2025 is not over. Sorry. I meant to say 2024. My bad. I messed up twice here recently. When I share my screen, look at this. I'm not sure if it lets me share this. I just go, okay, share this tab instead. Okay, so in 2024, it was a record year. 2024 was the highest. They're saying that the capital at play, dedicated capital, was at 769 billion. Okay, so there's not a decrease in the amount of capital available. There's just a lack of interest. There's a fundamental lack of interest to offer capital in these catastrophic prone areas. And if they are offering capital, I wouldn't say there's a lack of interest. What I'll say is there's a lack of interest to lower the terms of the attachment points of when the when the reinsurance would get triggered. So reinsurance is similar to insurance, to where they would have kind of deductible and say, all right, like for an event, your deductible would be $5 million or $25 million. And then we'll take everything above the 25 up to 100 million, and then the carrier needs to take the rest or something like that. So there is this kind of play at hand where there's plenty of capital, but there is not interest to provide enough coverage for an MGA or a carrier to feel comfortable offering lower deductibles on these homes or properties that they're insuring. So it leads to a higher attachment point demand from the reinsurers, which then flows down to the insured, the person like you getting home insurance or getting insurance for your property. It forces carrier MGU to have higher deductibles because they've got to reduce their risk because they've got less coverage for this catastrophic or these other type of coverages. So the general sense is that reinsurers are less comfortable with frequency events, like I would say like hail or these other things, and they're more interested in like catastrophic events. And I know my leading up to this conversation, like you might be like, wait, I thought that was the other way around. It is and it isn't. Like the piece about using the capital excuse, or there's not enough capital to cover. That's what I was getting at. And now that I've unfolded this story for you, it's really not about that. It's about it's about not being interested in lowering the terms and meeting halfway, like being very solid in having high attachment points and protecting their bottom line, which is fair. But that also affects the insured, so it flows all the way down. And that and then the higher attachment points means that there's less coverage for like a frequency claim, and they're really only covering these massive catastrophic claims. So the carrier and the MGAs need to figure out this frequency thing, and the solution for that is higher deductibles. So if you do have some kind of thing that happens, one, you may or may not have roof coverage because your roof is actual cast value, which means it depreciates over time. And if you have a shingle roof, it typically lasts 15 years. And then the other thing is that once you get to that point and you have these high deductibles, if you are submitting a claim, most likely your claim is going to be under your deductible because have a claim over 25 grand, like for a normal size place, that's a roof. That's a brand new roof. So unless you had like severe structural damage or something like that, there typically would be, in this scenario that I'm talking about, would be no coverage. You would have to pay out of pocket. And yes, it's, I guess, good for the insurance company, but not good for the insured. And I don't know if people explain it properly or people don't understand, but I don't think the person purchasing the insurance should have to have somebody sit them down and like really go through all the legal documentation and the contract language and all sorts of stuff for them to be like, oh, wow, like, so if I have a claim, it's going to be this much money. Or if I have a claim about this, like the value of my roof is like $3,000. I don't think all that stuff is clear, and the insurance industry has to do better with providing clarity to the people that are paying them. And that would probably avoid the last hypothesis that people don't understand insurance is becoming more complicated and people think of it as a scam. But insurance is really important. It helps the world go around. So it's a critical function. It's just that people just don't understand it. So the next thing is, how do home buyers feel, or people who own homes? They don't like the situation, especially in Florida and in California. They're in a bad spot. They don't understand why insurance is so expensive. They don't understand why the deductibles that they're able to obtain are so much. They don't understand why they typically won't have coverage for their roof if their roof is older. All of these things just don't make any sense. And then for someone to tell you, oh, well, if you want coverage, you have to get a new roof. And in their mind, they're like, okay, well, what about the roof I have now? Well, like that one doesn't have coverage because it's old. And he's like, oh, well, I have a roof and it works, but it's not worth anything. So I think the perspective needs to get explained a little bit more. Like from the insurance side, it's pretty clear. Like people were using insurance policies as maintenance policies for their roofs, and that gets very expensive for everybody else if everyone's getting a free roof. And the other perspective is, wow, like I have a roof. Like, why does my roof have no coverage? And so I'm not in those conversations because I'm not an agent, but yeah, I'd be curious on how they explain that and how that conversation goes. Because I assume it wouldn't be pleasant because I'd be like, what do you mean? What are you talking about? Like I need a new roof. I have got a roof. You're saying I don't have coverage because my roof is old, or like I can't obtain coverage from someone else because my roof is too old. Like there's just such a lack of supply that people can like completely dictate the terms of which they will offer coverage. And you were able to do that before, but the problem is now that there isn't enough supply for coverage. And so a lot of people are going to an insurer of last resort. And that is not good. Like Florida's is Citizens, and Citizens is the insurer of last resort. And when you're getting coverage from the insurer of last resort, you have substantially less coverage. You have a worse service. You will have all sorts of issues. And the main issue is that the Florida government is not supposed to be holding this much risk on their balance sheet. Because you got to think about it, like insurance is a risk, not a risk, it's a liability, sorry. It's a risk as well, but it's a liability. So when you get a policy and say your policy is for $100,000 worth of coverage and you paid out $1,000, or let's call it 1,200 because it's easier math. So you start your first month, you pay your 100, and then we have what's called earned premium. And so there's the earned premium asset. Like, so the money that you paid us, it's not really ours until it's earned. So you could request a cancellation at any time and we'd pay you back the money, rightfully so, because the contract was for 12 months. And if you don't fulfill the 12 months and you want to leave, then you get your money back. There is some concepts like pro rata or 25% minimum earned, but it's not necessary for this conversation. Basically, so that's a liability. Like the premiums is a liability. And then the other piece is like the catastrophic risk associated with your property is a massive liability on the balance sheet. The Florida, like their balance sheet is not equipped to have this much risk. And if something came through, like I don't even know how their account models, but if something came through and was the equivalent of over probably a 250 storm, then that would cause like massive, massive damage. Florida would not have enough money, and they would have to get not the reinsurance market. They would have to get the insurance carriers or people offering insurance in the whole state to do a special assessment, and then everyone has to pay out and hopefully make things right. But it's not a good situation for your government to be having to step in that deeply to help out and help the market, the private market, simply because it's very complicated and we shouldn't have that much risk on our Florida government balance sheet or any of these balance sheets. It's to help out while the market adjusts, right? Like the market needs to adjust and then stuff comes off the insurer of last resort. But the issue with states like Florida and California is that things aren't coming off of these insurers of last resort. What's happening is that people just keep getting added on to the insurer of last resort. And that creates some really bad downstream problems if you have a massive catastrophic claim. And like these states, you're having these things happen all the time. And in California, luckily enough, those two fires were counted as two events versus one event. And the way that that's derived in a reinsurance contract typically would be the distance and the time of occurrence. So if the distance is close enough and it occurred close enough, or the times occurred like close to each other, then it would be counted as one event. Whereas a hurricane, if it's a hurricane, like that's one event. So any of the tornadoes that a hurricane creates or hailstorms, that's all one event. Wildfire is a little different, but luckily that was classified as two events instead of one, because if it was one event, then it would have probably resulted in not full coverage, simply because you have a cap that would be paid out for one event. But they definitely probably exhausted their treaty and had to re-up on their coverage. So all of those factors in play have created this very aggressive environment for homeowners and for people who own commercial buildings, like an apartment or condo. Condos are owned by a group of people, but you know what I mean. It's owned by the board. So these pressures at play, I think that these are all true. These hypotheses are true. I mean, they might be a little nuanced, but very close to true or true. And that leads me into an idea that I discussed with my mom. When my mom is a crazy smart, and she's in insurance too. So it's great to have her around, and hope she stays around for a while. But yeah, she's very intelligent and also knowledgeable has knowledge in insurance. And that leads to sometimes interesting discussions about different ideas and discussing the parametrics. And I don't think she was ever like too open, not open, too optimistic about the parametrics. Like, there's always issues with regulations and other things, market adoption. There's companies that have been trying to do that for years and it hasn't worked out. But one thing that I think is curious and that we talked about was a deductible replacement coverage, where is you would offer coverage for people that had frequency. It'd be a frequency play, not a severity play. And basically what that means is, like, the company would offer coverage for everything under the deductible up to the deductible. So say your deductible in this instance was 25 grand. I would start in commercial, so the deductibles would be pretty big. Like, it would be like 500 grand or $1 million, depending on where I'm playing. It could be more, but yeah, it'd be a lot. Anyways, if you started with this house example, so $500,000 house, you have a 5% deductible. Your deductible is 25 grand. That deductible, or like that claim that you would have, say something happens to your house, you have a hailstorm, whatever, it costs $10,000, or some kind of lightning storm, the wiring got messed up. I don't know. Just throwing things out here. That happens. You would typically have to pay out the 15 grand yourself. I think I said 15. You'd have to pay out the 15 grand yourself. Whereas if you had deductible replacement coverage, you would pay, say, I mean, for $25,000 worth of coverage, you wouldn't pay that much. Like, you would pay, I don't know, a couple $100. And in that scenario, we would pay you the money, and then you would make things right with yourself. So you'd file a claim, and then the money would be paid out, but we wouldn't pay anything over your claim. So say that you had, because then that would mean that you have double coverage, and then you'd be better off than what you should have been, which goes against the rule of indemnity, which is basically making the insured no better than they were before with like materials or modern, or it depends on how the policy language is. Like for an older building, there might be some rules in there that if your building's super old, like we can't use horsehair for the ceiling or something like that. But all that put together, it provides an opportunity for someone to come into this market and create a product that makes insurance a little bit easier to understand and makes things easier for people to feel comfortable with insurance. Like I don't know, I don't feel that people are comfortable, and I think that's a business opportunity in itself. Like creating a company, and then the company's whole goal is to make insurance easy, where it's very customer centric and trying to find interesting ways to either package up policies to where the deductible is kind of taken care of with a separate coverage. They have a process of providing coverage like from ground up all the way, and being able to play in all the layers and start with the first layer, but then play with each layer of the insurance policy. And you may not know what I'm talking about, but that's fine. Play at each layer and start at the beginning, because deductibles are increasing. You could scale that to many products as long as you get the model in place. The coverage amount is really what matters. I think that's very interesting, and I appreciate my mom having that conversation with me. The next section is demystifying the parametrics insurance market. So I had previous episodes about parametrics, and if you're not familiar, it is basically a contract that has predefined data sources and trigger points. And so these would be called the data oracles and contract execution thresholds. With all that playing out, I had some deep interest in some ideas related to parametrics that, after interviewing some co-founders or leaders in that space, I came with different feelings. Like I came around to having different feelings is what I'll say. So one, I met with someone very optimistic about parametrics and wanting to bring it down a notch, where they're working in a very sophisticated space for large companies. And then I spoke with another founder who was less optimistic, and they were playing in multiple spaces within parametrics, but had mentioned some, I wouldn't say mentioned it, but had some undertones of regret. And so those are the two people that I spoke with. So let me talk about the first one, who was very optimistic. They think that bringing the sophistication downward, starting at the top, starting at the coveted, international businesses, like big business, like oil, energy, all that stuff. Oh, I guess I just reminded myself that I didn't talk about the alternative capital. I got distracted. All right, whatever. So regardless, starting big and then moving downward, and they're thinking about long-term vision of parametrics, like within like 15 years. And their perspective is, I'm in on everything. I'm in on homeowners. I'm in on commercial. I'm in on sophisticated multinational businesses. I'm in with everything. He's like, I'm not sold or married to one idea. I am bullish about the market of parametrics in general. And that's how I position myself, which requires a lot of capital and sophistication and backing and networking to do all those things. And that's not possible for a single founder. It's just not. If you have stupid money or connections, that would be possible. But starting out and getting started, that's ridiculous. But all of that very positive about parametrics. And then I spoke with somebody else that was closer to the space that I wanted to operate in, and they weren't very, I wouldn't say they weren't positive, but they definitely had undertones of regret of their decision of like insurance or parametrics in general. And apparently that their competitors and themselves like trying to divest their products into other areas, and like the things that they've launched that I'm not saying they didn't go well, but they were less revenue than anticipated, either from brokers telling them one thing doing another, or from just changes in the market, or just lack of market appetite after the product was made. And that really stuck out to me because it seems like such a good idea on the surface, right? Like everything is coming together. It looks like there's the infrastructure required to build something like that. There is the interest from capital markets. There is notations of interest with accelerators where this is like insurance accelerators, or this is what they're looking for. And so all these things seem good on the surface, but then when you pull back the covers or open up the sandwich, it seems it might be bologna. I don't know. I was trying to talk about the sandwich there, but let me backtrack on that one. If you pull back the covers, there might be some monster or ghost, and that's what it's kind of appearing like to be. Is that on the surface it seemed like a great idea, and then once I dug a little deeper, it doesn't seem as promising as it used to be, and that's disappointing because it seems very cool. And it's okay to pivot your idea and keep evolving the idea as long as you're not jumping from space to space. It's more at the angle of progressing the idea and getting closer to the source of truth and the problem at hand. And I have completely reevaluated how I was thinking about it. And I thought about, what do I know that is true or can be verified quickly? And so coming back to the hypothesis, I had said extreme weather events are increasing in severity and frequency. There is a lack of appetite from reinsurance markets to take on this frequency risk, but they're willing to take on the severity risk simply because there is plenty of capital, but not interest in lower attachment points. If someone is getting deductibles offered in these catastrophically prone areas, they're typically higher on the higher end, and them being high would notate that people probably can't afford it, or if they do have a claim, they probably don't have coverage unless it's a large claim. Then the next piece is insurance is becoming increasingly more complicated and makes less sense. So I think there's an opportunity, long-term opportunity to make insurance products that are simple, easy to use, and are understandable to, say, a 15-year-old. I think that's reasonable. And if you could do that, I think you could have a preference, and maybe people don't even care. Maybe they're like, you know what, whatever the cheapest price is, that's fine. But price is a big determinant. But also at the same time, understanding what coverage you legitimately have and don't have easily could be a value proposition that doesn't seem that too hard to execute on. But that was my overview of my ideas and my progression of my ideas. I am going to let everyone go. I appreciate your time today. And of course, as always, wherever you are in this world, good afternoon, good evening, good morning. I said that backwards. Thanks for listening in. I hope you tune in next week. Until then, bye.